The room where Canada's trade future was being decided this week did not look like a war room. There were no sirens, no emergency sessions, just a Prime Minister arriving at Parliament Hill on a Wednesday morning, April 22, 2026, stopping for a scrum of reporters outside the entrance, and then, in fewer than 90 seconds of unscripted candor, rewriting the terms of the most important economic relationship on earth. Mark Carney was asked a simple question: would Canada make any more concessions to the United States just to get to the negotiating table? His answer was a single syllable: no. Not, we'll evaluate the situation. Not, we're always open to productive dialogue. No. And that one word is now reverberating from Ottawa to Washington to the trading floors that track every tick in the North American supply chain, because it was not just an answer, it was a declaration. Here is what you need to understand before we go any further. The United States and Canada are not in a normal trade dispute. A normal trade dispute involves two sides disagreeing about a specific tariff rate, haggling over a sector, trading concessions until they find a number both can live with. That is not what this is. What is happening right now is a fundamental renegotiation of who holds power in a relationship that moves $2.5 billion worth of goods and services across the border every single day. And for over a year, one side has been imposing, demanding, and escalating, while the other side was expected to absorb it all quietly and then ask politely to be let back into the room. That era ended this week. And if you think this is just Ottawa versus Washington political theater, you have not been watching closely enough. Because embedded in this confrontation is a question that will determine what your heating bill looks like next winter. Whether the auto plant in your city runs 2 shifts or 1, and whether the trade architecture that has underpinned North American prosperity for 3 decades survives the next 12 months in any recognizable form. Let me introduce you to someone you should be thinking about right now. Her name is Marie-Claire. She works at an aluminum fabrication facility outside Saguenay, Quebec. She has worked the same line for 11 years. She earns about $52,000 a year. She has a mortgage, 2 kids. Her plant produces aluminum products that feed directly into American manufacturing supply chains: aerospace components, auto parts, packaging. She did not vote on tariffs. She did not negotiate CUSMA. She does not follow the daily scrums outside Parliament Hill. But every word spoken in Washington and Ottawa this week is landing directly on her paycheck. Marie-Claire is who this story is actually about. Remember her name. We know what is happening at this level because the evidence is not theoretical anymore. It is documented. It is in Statistics Canada quarterly output reports. It is in the Financial Accountability Office of Ontario's modeling. It is in the Congressional Research Service assessment published in March. It is in the Radio-Canada reporting, confirmed by 4 separate government sources, that the Trump administration has been demanding what officials are calling an entry fee, a series of pre-negotiation concessions from Canada before formal CUSMA review talks can even begin. The demand is not subtle. Before Canada gets a seat at the table, Canada must give something up. The liquor has to go back on the shelves. The digital services tax has to be addressed. The Buy Canadian procurement preferences have to be walked back. Give first, negotiate later. That is the structure of the ask. And this is where Carney's response becomes not just politically significant, but historically significant. Because Canada has been in this exact position before. And previously, Canada gave. The country withdrew counter tariffs. It pulled the digital services tax. It bent. And what did bending produce? More demands. The entry fee grew. The tariffs did not come down. The sectoral levies on steel, aluminum, automobiles, and forest products did not lift. The pattern is now documented. Concession invites escalation, not reciprocity. That is not a political talking point. That is the record of the last 14 months. Picture the moment Carney made that calculation. Not the scrum outside Parliament, the earlier moment, the private one. Somewhere between the Radio Canada report dropping and the Wednesday morning scrum, a decision was made. Not made by committee, not written into a press release. Made by a man who spent his career reading markets, who understands leverage the way most politicians understand polling, and who concluded that the path that looked like cooperation was actually the path of deepest surrender. He did not say, "We'll consider it." He did not say, "We have areas of mutual interest to explore." He walked out into the cold morning air on Parliament Hill and said no. One syllable, no hedging, no diplomatic softening. What was he actually thinking in that moment? The psychological tell is in the specific word he chose when he pivoted. He didn't just reject the demand. He reframed the entire premise. When the U.S. Trade Representative Jameson Greer called Canadian provincial liquor bans and procurement policies trade irritants, Carney did not dispute the word choice. He demolished it. He redirected the entire conversation with a question that lands like a verdict. You want to talk about irritants? A 50% tariff on steel and aluminum is more than an irritant. A 25% tariff on automobiles is more than an irritant. The tariffs on every forest product that crosses this border are more than irritants. Those are violations of the trade deal we both signed. The word is not irritant. The word is violation. That linguistic shift matters more than it might appear. In international trade, the distinction between an irritant and a violation is the difference between a grievance and a legal claim. Irritants get managed at the margins. Violations get confronted at the center. By insisting on the word violation, Carney has placed the entire Section 232 tariff structure, steel, aluminum, autos, lumber, inside the scope of CUSMA review. The Americans have been trying to wall those sectoral tariffs off, keep them separate, treat them as national security measures untouchable by trade negotiation. Canada is refusing to accept that wall. Canada-U.S. Trade Minister Dominic LeBlanc has been explicit. Canada will not accept a one-off deal on CUSMA, while industries hit hard by sectoral tariffs are left for some separate, future, hypothetical negotiation. The two tracks are one track. That is the Canadian position. And Carney just staked his entire political capital on holding it. Now let's look at the receipts, because this dispute is not abstract. The numbers have been running for over a year, and they are not gentle. Aluminum producers in Canada, the ones supplying the plants where Marie Claire and workers like her report every morning, contracted output for 4 consecutive quarters. By the end of 2024, Canadian aluminum production was down nearly 20% on a year-over-year basis. 20%, not a rounding error, not a seasonal dip, a structural collapse caused by a 50% tariff applied to goods explicitly covered by a trade agreement that the United States helped write, signed, and championed. The irony that the Section 232 national security tariffs have been invoked to target a country that shares a continent, a defense alliance, and a 70-year integrated supply chain with the United States is not lost on anyone in Ottawa, and it should not be lost on you. But here is where it gets worse, because the damage is not flowing in one direction. The downstream consequences of these tariffs on American industry are documented and severe. Corporate profits for U.S. fabricated metal manufacturers, the companies that buy Canadian steel and aluminum as inputs, fell 30% between the fourth quarter of 2024 and the second quarter of 2025. 30%. The Peterson Institute calculated that when the 2018 version of these tariffs were applied, U.S. steel users paid $5.6 billion more for steel in a single year. The 2025 version is broader, steeper, and more persistent. American downstream manufacturers are paying the bill. American consumers are absorbing it in prices. The idea that this is a policy that punishes Canada while the American economy sails through unharmed is not just wrong, it is the opposite of the evidence. Think about Marie Claire right now. Her plant output is down nearly 20%. Her employer has delayed capital investment because of tariff uncertainty. 1 in 5 Canadian manufacturers told Statistics Canada they were deferring expenditures because of U.S. tariffs. The factory did not close, not yet, but the second shift is gone. Overtime has dried up. Her mortgage is fixed. Her grocery bill is not. And the question of whether her plant survives the next 12 months depends entirely on whether a trade framework gets resolved before the July 1st CUSMA deadline that neither side now expects to meet. Here is the third receipt. The manufacturing sector across Canada shed 51,800 jobs in the 12 months through February 2026. 51,800 positions. That is not a projection. That is Statistics Canada's labor force survey. The bulk of those losses concentrated in Ontario, in the auto and metals corridor that stretches from Windsor to Hamilton. The Financial Accountability Office of Ontario projected that in 2026, right now, this year, Ontario's primary metals sector would see real GDP down 18% below the no-tariff scenario. The motor vehicle industry, down 12%. These are not numbers from an advocacy group. These are from a nonpartisan provincial fiscal watchdog. And the fourth receipt is the one that everyone in Washington should be reading more carefully than they are. Canada's response to all of this was not capitulation. It was diversification. Annual energy exports to countries other than the United States rose 22% in 2025, reaching $28.8 billion. Canadian aluminum exports to the Netherlands and Italy grew from $738 million to $2.1 billion in a single year. Canada is not just holding firm rhetorically. Canada is rewiring its trade architecture in real time. Every month that these tariffs persist, Canada builds new market relationships that do not require American approval. The leverage the U.S. assumes it holds over Canada erodes a little more every quarter. Here is what every other outlet is missing, and I want you to stay with me here, because this is the part that changes how you read everything else in this story. The entry fee demand, the insistence that Canada make pre-negotiation concessions before formal CUSMA talks can begin, is not actually about liquor or dairy or digital services. Those are the surface demands. What is actually being tested is a procedural principle. If Canada agrees to make concessions before the negotiation begins, it has accepted the premise that the United States gets to set the starting line. It has established the precedent that one side comes to the table having already paid, and the other side comes to the table with its demands intact. Once that precedent is set, it does not go away at the end of this negotiation. It becomes the architecture of every future negotiation, every future review, every future moment where Washington wants something and Ottawa has to decide whether resistance is possible. Let me translate that for you in plain language. The entry fee is not a one-time cost. It is a toll booth that once built never comes down. If Canada pays it this time, the booth gets taller next time. The precedent being established right now is not about whether American whiskey goes back on LCBO shelves. It is about whether Canada is a sovereign negotiating partner or a tributary state that pays admission before being allowed to speak. That is what Carney said no to. That is why the single syllable landed so hard. Drop your answer in the comments right now. Do you think Canada can hold this line all the way to July 1st? Or does the economic pressure eventually force Carney's hand? I genuinely want to know what you think, because that question is not rhetorical. It is the hinge that everything else turns on. What you are about to understand is something that has not been explained properly anywhere in the mainstream coverage of this story. The specific strategic logic that makes Carney's position not just principled, but actually optimal from a game theory standpoint. And to see it, you have to understand what kind of negotiator Donald Trump actually is, where that approach is constructed to work, and exactly why Canada is the wrong opponent for it at the wrong moment in North American history. The Trump negotiating doctrine is documented across 30 years of real estate deals, licensing agreements, and geopolitical confrontations. The structure is consistent. Establish an extreme opening position, create urgency and pressure, demand pre-concessions to prove the other side is serious, then negotiate from a position where your baseline is already above where you want to end up. It is a doctrine engineered for asymmetric relationships. Relationships where one party needs the deal more than the other, where the cost of walking away is fatal to only one side, where the weaker party cannot absorb a prolonged standoff. In plain language, that means the Trump method works on counterparties who cannot afford to say no. And this is precisely where the playbook collides with reality when applied to Canada. Because Canada is not a party that cannot afford to say no. The United States imports 64% of its crude oil from Canada. 64%. Canada is the largest supplier of U.S. energy imports. The integrated automotive supply chain, where parts cross the border 6 or 7 times before a vehicle is complete, cannot be unwound quickly, cannot be replaced with domestic production in any timeline that is politically meaningful. The U.S. is dependent on Canadian critical minerals, Canadian energy, Canadian manufacturing inputs in ways that make the standard pressure and capitulate doctrine structurally mismatched to this bilateral relationship. In plain language, that means the map of leverage in this relationship does not look the way the Trump administration's public posture implies. And Carney, the former governor of the Bank of England, the former governor of the Bank of Canada, the man who has spent his career understanding how systems of interdependence actually function, knows this map cold. Notice what Canada did not do. When the entry fee demand leaked through Radio-Canada's reporting, Canada did not immediately call an emergency caucus meeting. It did not issue a formal diplomatic protest. It did not convene a press conference to denounce the Americans. What Carney did was walk out of a building on a Wednesday morning and say no to a reporter's question. That restraint is itself a signal. It says, we are not panicking. We are not desperate. We have read the leverage map. We know what we have, and we are prepared to wait. The historical analogy that applies here is not a trade dispute. It is the 1987 free trade negotiations, when Canada walked away from the table entirely, when the Americans refused to accept a binding dispute resolution mechanism. Canada's chief negotiator at the time, Simon Reisman, left Washington, got on a plane, went home. And the Americans came back with a dispute resolution mechanism in the deal. The doctrine Carney is applying right now has Canadian historical precedent. Principled refusal produces results that strategic accommodation does not. That is the Reisman doctrine, and it is alive in Ottawa today. 3 experts have been watching this play out, and their consensus is striking. David McNaughton, former Canadian ambassador to the United States, said this week that Carney's approach reflects an understanding that the worst thing Canada can do is negotiate against itself. You give the Americans what they want before you sit down, and you have already lost the negotiation before it began. That is not a strategic concession. It is a strategic surrender. Lawrence Herman, a veteran Canadian trade lawyer, framed it this way. The Section 232 tariffs are facially inconsistent with CUSMA. They are applied on national security grounds to a country that is part of the North American defense structure. The legal argument that Canada has a right to insist on their inclusion in the Trade Framework Review is not a negotiating position. It is a legal position. Canada is not asking for a favor. Canada is asking for the agreement to mean what it says. Dan Churiak, former Deputy Chief Economist at Global Affairs Canada, has pointed out that Canada's export diversification data is now changing the risk calculus. Every new market Canada builds for its aluminum, its energy, its forest products slightly reduces the leverage the U.S. assumed it held through market dependency. The Americans are negotiating against a target that is slowly becoming less dependent on the outcome. And when former U.S. Trade Commissioner advisors and Canadian former ambassadors and trade lawyers all converge on the same structural conclusion, that the current U.S. approach is built on an assumption of Canadian dependency that the evidence no longer supports, you pay attention. To be fair, there is a real counter-argument here, and it deserves more than a straw man. The strongest case for Canada making pre-negotiation concessions is this: 73% of Canada's goods exports go to the United States. That is not a relationship you can restructure in a year. The 22% increase in non-U.S. energy exports is meaningful, but it barely touches the volume still moving south. Ontario's manufacturing corridor, the auto plants, the steel mills, the parts suppliers, is so deeply integrated into American production that there is no viable short-term alternative. A prolonged impasse does not hurt both sides equally. The Canadian economy is significantly more exposed to disruption than the American one. And every month without a framework resolution is a month of investment delays, plant uncertainties, and workers like Marie Claire wondering whether their plant will survive the review. These are not bad faith objections. They are structural realities. The pivot back to Carney's position, though, is not an opinion. It is a process argument. The question is not whether Canada is exposed. Canada is exposed. The question is whether making pre-negotiation concessions reduces that exposure. And the evidence of the last 14 months is that it does not. Canada made concessions. Canada withdrew counter tariffs in September 2025. Canada addressed the digital services tax. Canada bent. The steel tariff stayed at 50%. The aluminum tariff stayed. The auto tariff stayed. Concessions did not produce reciprocal movement. They produced more demands. The structural logic of Carney's position is not idealism. It is a conclusion drawn from empirical results. Here is how this lands in the next 90 days for people who are not trade analysts, not politicians, and not watching Parliament Hill scrums. The first tier is personal and immediate. If you work in manufacturing in Ontario, Quebec, or British Columbia, or if someone in your household does, the next 3 to 6 months are the window that determines the employment picture heading into the fall. Statistics Canada reports that manufacturing has shed nearly 52,000 jobs in the last 12 months. The rate of shedding is not accelerating, but it is also not reversing. A framework resolution that includes meaningful tariff rollback could trigger investment decisions that were deferred. Capital expenditures that were frozen unfreeze. Shifts that were cut come back. Conversely, continued impasse means the investment delay calculus compounds. The longer the uncertainty, the deeper the structural adjustments manufacturers make. And structural adjustments in manufacturing are not easily reversed. Marie Claire's plant has survived the first year of this, but the second year is where plants start making permanent decisions. The machinery that goes unmaintained. The expansion project that gets permanently canceled rather than deferred. The workforce that ages without new hiring. The second year of a trade disruption is when temporary becomes structural, and we are in the second year. The second tier is political. Carney won a federal election on the strength of a message that Canada would not be pushed around, would stand firm, would negotiate from sovereignty rather than from fear. That mandate is now being operationalized in real time. The political risk is not that he holds the line. The political risk is that holding the line produces a prolonged stalemate that the Canadian economy absorbs in ways visible to voters before a resolution materializes. The CUSMA July 1st deadline is now publicly acknowledged by both sides as unrealistic for a full review. That gives Carney political space to extend the timeline, but the economic exposure compounds with every quarter without resolution. The political window for holding firm narrows as the economic costs mount. The third tier is systemic, and it is the one that outlasts both of these men's political careers. What is being established in this dispute is a precedent for how the United States uses trade agreements with its closest partners. If a country that helped write CUSMA, helped ratify CUSMA, and has been compliant with CUSMA's framework for decades, can have 50% tariffs applied to its core export sectors on national security grounds, and then be asked to make pre-concessions just to discuss whether those tariffs might eventually come down, then the architecture of binding trade agreements is fundamentally weakened. Not just for Canada, for every country that has bet its economic strategy on the durability of rules-based trade frameworks. The precedent being set here echoes far beyond North America. What Canada does in the next few months is being watched in Brussels, in Tokyo, in Canberra, in every capital that has a significant trade agreement with the United States, and is now recalculating what that agreement actually guarantees.